Good evening, welcome to our Volatility Modeling and Value-at-Risk presentation for the selected topic list in risk management course. First of all, I would like to introduce a list of members in the group: Disaya, Nakarin, Phuket, and Suphawit. Since there are 6 questions, we will run through it one by one. For the first question, we select the 5 stocks from the set 50 from the Stock Exchange of Thailand. The list of stocks are the PTT, KBank, CPF, CPN, and BBL. And the six in the function is the adjusted closing price from the Yahoo Finance. It is the stock price that adjusted with the corporate actions such as dividend, stock split, and the capital gain. And the time period is 15 years from the 3rd Jan 2007 to the 23rd May 2020. And there are 3,076 observations and it keep increasing every day. And after we have the price for the each selected stock, we calculate the daily return, mean, variance, and the skewness, and the courtesy of the each selected stock since the inception of the data, which we will be used in the next section. And we use the plot function to illustrate the chart with the selected matrix size corresponding to the row and column from the function pi m flow. And here we have the pie line chart, return line chart, and the histogram chart. And the mean return of the each selected stock is quite stable, and there is a volatility clustering, which the high volatility period are followed by the high volatility. And here the histogram show that the return distribution are not normally distributed due to they do not follow the bell curve shape of the normal distribution.
For the next question, the next part, we need to find best fit mean model. For the mean model, first we need to find the best fitted lag ARMA PQ for each stock to use in a regression analysis. We will run this command auto arithma to find the best fitted ARMA model, and then we run this. Okay, we run this. Now the results are shown below. As you can see in the result, this indicates the best lag ARMA of our stock, and for PTT, the best mean model is ARMA 00. Then we note the result for the stock, and we will run this command again, arithma command again for other stock. After we run this arithma command for every stock, finally we can get the best fitted mean model for every stock. We still can use the mean model of each stock to forecast mean of each stock in the next period. For the example, we'll use this command forecast to find a forecast mean in the next 5 days. And this is the result for the forecast command for each stock. As you can see, the results are shown the forecast mean model for the next 5 days. And for the best lag PQ that we get from the arithma command above, we will apply this lag in the volatility model, which we will run in the next part. The next part is we will find the best volatility model with card model.
So for the volatility model, we have 5 models for each stock, which we will choose the lowest AIC to be our best fitted volatility model. So the first model starts with normal distribution with standard cash. So we run for each stock PTT, KBank, CPF, CPN, and BBL. Same as model 2, which is normal distribution with E-cash model. For model 3, normal distribution with GJR cash model. And model 4, skew normal distribution with standard cash. And model 5, which is the student T distribution with GJR cash model, and this is the best model for all 5 stocks. After we get the AIC result, so the cost can be defined here. UCash spec with the distribution model STD, and the model volatility model is GJR cash, and the ARMA order for each stock we use the same that we get from the previous section. Then for question 4, we find the distribution of each stock to get the shape parameter, and here is the shape for each stock. Start from PTT, KBank, CPF, CPN, and BBL. The shape parameter will help us to find the value at risk of each stock for the next 5 days. But first we have to use UCash forecast to forecast the mean return and sigma of each stock for the next 5 days using UCash forecast. And the volatility model that we get from the last section from our best fitted model, and then we forecast it for the next 5 days. So for example, the value at risk of PTT for the next 5 days, we define mean return for T plus 1, T plus 2, T plus T, T plus 4, and T plus 5. Then we define the sigma of PTT for T plus 1, T plus 2, T plus 3, T plus 4, and T plus 5, and then we use alpha at 0.5, and the VAR for tomorrow can be used the code QDIST, and using the distribution STD, alpha, and mu that we define here, sigma that we define here, and shape of PTT, shape parameter of PTT that we define from above here, and then we get the VAR forecast for PTT for tomorrow, minus 1.8%, and for the next 5 days is minus 1.9%. Same as KBank, we use the same code and we get the result. So VAR for tomorrow of KBank would be minus 2.1%, and for the next 5 days is minus 2.18%. Similar with other stock CPF, CPN, and BBL. We get the result here for the next 5 days of each stock. Now we here at the question 6. So because deriving data from Yahoo Finance, the number of observations increase every day, therefore define the sample size and range in variables ABC will help us writing code easier. So right now we have 3,760 observation, and for the last 300 day trading day we will start at the 3,460, which will be our end start here for the code. So in order to forecast 95% VAR for the last 300 days, we use UCASH row, which forecast return and sigma of each stock for the last 300 trading days using this function, and re-estimate each model every 20 days using refit.every equal 20, and we do it for every stock PTT, KBank, CPF, CPN and BBL. Then the result from this section will be used next here. We will use the sigma and Q this function and mean of each stock to forecast our 95 value at risk of each stock for the last 300 days. So this line will be the forecast 95% VAR for PTT, and this for CPN and BBL. We will see our result clearly if we plot the graph. So in order to plot the graph, we plot it compared to the actual return of the last 300 trading days, which will be the gray dot, and our 300 rolling VAR that we forecast from the previous section will show in the black line, and if the actual return is below our forecast VAR line, the red dot will be shown. So I can show you the code here. So we plot x1 to 300 to specify the last 300 trading day, and when we define the color here, the gray color will be a normal actual return, and the red color will be the actual return that below our forecast VAR, and we do it for every stock PTT, KBank, CPF, CPN and BBL, and then we print our result here. This for the PTT. So the daily return of PTT from the last 300 trading day we will be shown in the dot, and if it below the black line, which is our forecast VAR, it will show red, which we can count here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So from the last 300 days, actual return goes below our forecast VAR 12 days, but it will be easier if we write the code to count the red dot, which I will show you the next section. So here is the result from KBank, CPF, CPN and BBL. To write the code for counting the red dot can be shown here, but in this code we add the delta normal approach as well, so we can see both two results and compare it together. So here is the result of the delta normal approach for PDT. The actual return drops below VAR only 2 days, but from our cash approach it drops below 12 VAR 12 day, and for KBank 21 day, CPF 9 day, CPN 17 days, and BBL 19 days, which is more appropriate in my opinion, because our ARIMA and cash model using the best fitted model, and it shows us that the daily return of stock tend to be student T distribution than normal distribution. So here is the end of our presentation. So we all thank you and end it now. Thank you.